Warren Buffett didn't build his fortune by being perfect. He built it by avoiding the mistakes that ruin most investors. And if you're just starting out, these 15 financial blunders could cost you more than money. They could set you back years. The difference between those who grow wealth and those who lose it? Learning from the mistakes of others. Buffett has seen it all, and in this video, we'll break down the biggest traps new investors fall into and how you can dodge them to build real, lasting wealth. Let's get started. First, aggressive growth projections. Imagine you're looking at a stock and thinking, wow, this is a little pricey, but if this company can just keep growing its profits, it'll be a steal in a few years. It's a thought a lot of people have when they see a stock with a high price tag, but potential for big growth. But here's the catch. Expecting huge growth year after year is a dangerous game. It's easy to get excited about the idea of a company growing fast. But here's why it's hard to make that kind of growth happen, and why betting on it can backfire. Think about it this way. Imagine you're buying a house for $500,000, expecting its value to increase by 15% every year. In the beginning, that sounds great. But by the third year, your house would be worth over $700,000. The problem is that kind of growth is really tough to maintain, and the same applies to companies. High growth is harder to pull off than it seems, and very few big companies can sustain that level of success over the long term. Now, I'm not saying you should avoid investing in growing companies altogether. In fact, Warren Buffett loves investing in companies that can grow, especially if they don't need a ton of extra money to do it. But there's a huge difference between investing in solid growth and chasing growth for the sake of growth, which is something a lot of investors get caught up in, especially when interest rates are low and everything seems like a good deal. Here's where it gets tricky. If you're buying a stock that's priced at 20 times its earnings or higher, you're counting on that company to grow a lot just to make a decent return on your investment. But as Buffett points out, this kind of growth is rare. In fact, among the S&P 500 companies from 2012, only 40 of them managed to grow their earnings at 15% or more. That's just 1 in 10th. So picking the right company out of that small group is a challenge. This doesn't mean you should steer clear of companies like Tesla, Nvidia, or Intuit, but it's a reminder that if you're betting on rapid growth, you need to be extra careful. Growth isn't guaranteed, and betting on unrealistic expectations can leave you disappointed. Just because a stock looks like it might skyrocket doesn't mean it will. 2. Using a lot of leverage. Let's talk about leverage. It sounds like a quick way to get rich, but it can really mess you up if you're not careful. Leverage means borrowing money to invest, and while it can amplify your gains, it can also amplify your losses. Think of it like borrowing someone else's car to go on a road trip. You might make it to your destination, but if something goes wrong, you're responsible for the damage, and it could cost you big time. Here's the real risk with leverage. If the market moves against you, you might be forced to sell at a loss, even though your investment idea was right in the long run. Let's break it down with an example. Imagine Harry, a hedge fund manager, decides to bet against GameStop by shorting the stock. This means he borrows shares of GameStop from someone else and sells them, hoping the price will drop so he can buy them back at a lower price. Harry borrows shares worth $1 million and puts $500,000 down as a security deposit, kind of like a down payment on a loan. At first, everything looks good. GameStop is struggling, and Harry's betting that the stock price will drop. But just a week later, instead of going down, GameStop's stock price starts going up. It jumps from $19 to $31 per share. Now, Harry owes more money because the price of the stock he borrowed has gone up. The broker tells Harry that he needs to put up more money to keep his position open. This is called a margin call. Harry has to add $600,000 to his account just to stay in the game. But it gets worse. A few days later, GameStop's stock price rises even more, all the way up to $47 per share. Now Harry owes over $2.5 million to the broker, and the broker hits him with another margin call, demanding $1.1 million more. At this point, Harry is in trouble. He doesn't have the money to cover the margin call, so he's forced to close his position by buying back the shares at a huge loss, $1.5 million. Even though Harry was right about GameStop being overpriced and eventually crashing, the leverage he used prevented him from waiting it out. Because he was borrowing money, he had to sell when things went against him. If he hadn't borrowed money, he could have waited for the price to fall and made a profit. But because he used leverage, he lost big, even though he was right in the long run. The point here is that leverage can force you into making decisions you wouldn't normally make. It's like trying to play a game of poker, but being forced to fold before you've even had a chance to see how the game unfolds. In the world of investing, patience is key, and leverage can rob you of that. So while leverage might seem tempting, it can be a dangerous game to play. 3. Timing the market. Warren Buffett and Charlie Munger don't spend much time thinking about the overall market. They focus on individual businesses. It's tempting to try to predict what the stock market will do, but no one has really made a lot of money consistently predicting the market's movements. A lot of people, however, have made money by picking good businesses. That's what Buffett and Munger do. Trying to guess what the market is going to do is a trap that many investors fall into. Even the great Benjamin Graham, who was Buffett's mentor, got caught up in it. Why? Well, it's because there's a certain allure to trying to predict market movements. It feels like you could catch the next big wave if you know what's coming. But the market is unpredictable. You might pick a great company, but then something like a global pandemic happens and throws everything off course. Or maybe interest rates go up, inflation rises, or there's political instability. All factors that can impact your investment, even if the company you chose is solid. This is where people start thinking, if I can just buy when prices are low and sell when they're high, I'll make a fortune. It sounds simple, right? But it's not. Buffett always says that you should focus on two things: what's important and what's knowable. You know that interest rates affect the market, but can you really predict what's going to happen next? No one can. Not even Jerome Powell, who runs the Federal Reserve, knows for sure what will happen in the next meeting. And that's just one thing among many that could affect the market. Instead of getting caught up in predicting the unpredictable, Buffett focuses on what he can control, finding great companies at fair prices. Think of it like picking a sturdy boat for a long journey. Sure, there might be storms ahead, and sometimes you'll lose a boat along the way. But over time, the best boats will help you sail through the rough waters, and you'll do well in the long run. 4. Getting attached to your purchasing price. When you buy a stock for $50 and the price drops to $10, it can feel terrible. But at the same time, someone else who bought at $10 might now feel great because their stock is worth $50. The problem is, how you feel about the stock doesn't affect its price at all. It doesn't matter if you're up or down on your purchase, the stock will continue moving based on its future performance. Let's take Amazon as an example. Arnold bought Amazon stock in June 2022, and now after a few months, he's up 5%. He probably feels good about that since it's only been a short time. Ben, on the other hand, bought in July 2021 and is down 38%. Then there's Katie, who bought Amazon 5 years ago and has seen her investment grow by 133%. So does any of this matter? Should Arnold, Ben, and Katie treat Amazon stock differently because of when they bought it? Should Arnold or Katie sell to lock in profits? And should Ben hold on hoping to break even? The answer is no. What really matters now is what Amazon is likely to do in the future, not what happened in the past. If Amazon goes up 50% over the next year, Arnold, Ben, and Katie will all see a 50% return from where it is now, regardless of when they bought it. The key lesson here is that investors often get too attached to the price they paid for a stock. But the stock doesn't care about your purchase price. It's all about the future. As Warren Buffett says, treat every investment like it's a fresh start. Don't let past decisions cloud your judgment. Focus on where the stock is going, not where it's been. 5. Missing the forest for the trees. When it comes to acquisitions, we've made our fair share of mistakes. But the mistakes are rarely about the small stuff, like a bad lease, a questionable patent, or a labor contract. Those things are just details. What really matters are 3 key factors: the future of the business and its industry, the quality of the management team, the price you're paying. If you get these 3 right, the little details don't matter as much. Warren Buffett, for example, is known for making decisions quickly, sometimes in just 15 minutes. Of course, his experience plays a big part in that. But he also keeps things simple. He doesn't dive into every single detail that other investors might obsess over. Instead, he focuses on those three things: the business's future, its management, and the price. The danger of focusing too much on the details is that you could lose sight of the bigger picture. I've been guilty of this myself. I spent over a month researching different stock market companies recently, and because of that, I wasn't able to post any videos on this YouTube channel. I got caught up in the details. But one thing I've learned is that it's okay to do a deep dive into the details sometimes, but then it's important to step back and see the bigger picture. For instance, I spent a day or so looking at a Swedish kitchen company called 𝐌𝐨𝐫𝐞. I broke down the business into three categories: growth, the business itself, and management, and gave each a score from 1 to 5. I jotted down the key points in each category. Then I created a simple graph showing the company's cash flows and how it's currently performing. When I compare this to other companies I've looked at, it gives me a solid picture of the potential for each one. From there, I can make a decision about which companies have the best prospects for the future. So the bottom line is, focus on the big picture. Get the fundamentals right: future economics, management, and price, and you won't get lost in the weeds. 6. Staying active all the time. Investing isn't about jumping in every day and making constant moves. In fact, if you feel like you need to invest all the time, you're probably setting yourself up for mistakes. The trick is to be patient and wait for the right opportunity, the fat pitch. Think about it like this. Imagine a tennis player. Who's more likely to succeed, the one who plays 5 games a day or the one who plays 5 games a year? Or how about the author who writes 5 times a week versus the one who writes 5 times a year? Same goes for investing. The person who buys 5 stocks a week is probably going to make a lot of mistakes. But the one who buys only 5 stocks a year, carefully selecting each one, is going to have a much better chance at success. In investing, sometimes doing nothing is the best move. You can't expect to find a great deal every single day. There will be times when opportunities are everywhere, like in a market crash or bear market. But in a bull market, even if you look hard, you might not find anything that's worth buying. And even when there are opportunities, they may not be in industries you know well enough to take advantage of. Warren Buffett compares investing to baseball. A good investor is like a batter who never strikes out. You don't swing at every pitch that comes your way. You wait for the big, easy one, the fat pitch. And when it comes, you swing with confidence. 7. Diversifying too much. If you're really good at picking businesses, owning more than 6 might be overkill. Think about it this way. If you can find 6 amazing companies to invest in, that's probably all the diversification you need. You're going to make a lot of money focusing on those. The mistake comes when you try to add a 7th company instead of doubling down on what's already working. Most people don't get rich by finding their 7th best idea, but many get rich by sticking to their best idea. Now, diversification is a topic that gets a lot of attention from investors. To keep it simple, if you're not actively researching and learning about individual companies, diversifying into something like an index fund can be a good move. This protects you if you're not able to keep up with the details of specific businesses. But if you're someone who loves staying informed about companies and industries, you have an advantage. By focusing on your knowledge, you can beat the average market returns. For example, if you invest in the 30 biggest companies in the S&P 500, you'll likely see returns that mirror the index. You won't beat it. Here's an analogy. When I was younger, people used to think that mixing different types of alcohol would make the drink stronger. So they'd mix a 40% liquor with a 30% liquor, thinking it would give them a 70% drink. But really, adding something weaker just dilutes the mix. It's the same with your investments. Adding a 7th pick that's not as strong as your top 6 will only water down the results. For the record, I personally own 10 stocks right now, but the right number of investments is something every investor will debate forever. 8. Confirmation bias. The human mind has a pretty unique way of processing information. We're all wired to make new information fit into our existing beliefs, so we don't have to change our views. It's like when you've already made up your mind about something, and no matter what new facts come in, you twist them to support your original conclusion. Charlie and I have made big mistakes by falling into this trap ourselves. We've been too stubborn to reconsider things we thought we knew for sure. Charlie Munger likes to use a funny analogy to explain this. He says the human mind is like a human egg. When one sperm gets in, the egg shuts down to prevent any more from getting through. It's like we close ourselves off from new possibilities once we've already made a decision. As investors, this tendency can be costly. We love to find new information that supports what we already think. But what we really should be doing is questioning everything and being open to changing our views. We need to stay rational and continuously weigh the pros and cons of the companies in our portfolios. I've struggled with this too, but over time, I've found two strategies to help avoid falling into this mindset: the darling killing funnel and the bear pill. Here's how the darling killing funnel works. Let's say you want to keep 10 companies in your portfolio. Before you make your decision, you should start with at least 20 potential candidates. These aren't companies you just glance over. You should spend time researching them, like I did with Nobia, which I spent a day or so analyzing. By forcing yourself to narrow it down from 20 to 10, you'll be more objective and less attached to your initial favorites. The bear pill is about being intentionally critical before you add anything new to your portfolio. Before you invest, actively search for the potential problems or risks associated with the company. If you can, get a friend to play the role of a devil's advocate and point out the flaws. This way, you're less likely to ignore important red flags just because you're excited about the potential. 9. Following the herd. People often make the same mistakes over and over again, especially when it comes to investing. They get scared when everyone else is scared, and they get greedy when everyone else is greedy. Charlie and I don't have some magical ability that others don't. What we do have, though, is the ability to stay calm and not get caught up in what other people are doing. While everyone else is reacting to the crowd, we try to stay level-headed. If you've ever thought about investing, you've probably noticed that it's full of counterintuitive ideas. For example, the idea of jumping over 7-foot bars might seem like a good challenge, but it's just setting yourself up for failure. Similarly, staying active all the time isn't always the best strategy. In life, sometimes following the crowd works. If your friend's like your girlfriend, she's probably a good person. If a lot of people rave about a movie, chances are you'll enjoy it too. And if people are jealous of your career, you're probably doing something right. But investing is different. The crowd doesn't always know best. In fact, if everyone around you is hyped up about a stock, that might be a sign to stay away. As another investor, Howard Marks, wisely puts it, what's clear to the broad consensus of investors is almost always wrong. Why is that? Because a great idea doesn't always make a good investment. Take Tesla, for example. It might very well dominate the car industry one day. But if the stock is already priced as though it's achieved that, then buying it becomes a bad move, no matter how good the company is. One of the biggest mistakes I've made in investing happened when I followed the crowd without thinking it through. A close friend of mine had made a lot of money by investing in a small startup, and I decided to jump in. I didn't really understand the company or its industry, but because my friend was doing well, I thought I'd give it a shot. Spoiler alert, that decision could turn out to be my most expensive mistake. It's not over yet, but if it doesn't end up costing me big, I'll be incredibly lucky. 10. Jumping over 7-foot bars. Some businesses are just easier to understand than others. Charlie and I prefer things that are straightforward. We'd much rather do simple math, like multiplying by 3, than trying to figure out complicated numbers like pi. It's just easier that way. In the investment world, there's a common misconception that if you tackle a big, complex challenge, you'll get a bigger reward. People think that if you clear a 7-foot bar, the prize is worth more than if you clear a 1-foot bar. But that's not true when it comes to investing. This mistake is easy to make because in many parts of life, like sports or problem solving, the harder you work, the bigger the reward. But in investing, it's not about making things complicated. Trying to solve tough problems, making wild predictions about industries, or doing complex math doesn't usually lead to success in investing. In fact, it can be disastrous. Just look at the story of long-term capital management. Some of the brightest minds in finance thought they could handle incredibly complex models, but it ended in a huge loss. The key to success in investing is much simpler than that. If you can find a solid company in a growing industry run by honest, hardworking people and buy it at a fair price, you're on the right track. Simple ideas like these are often the ones that deliver the best results over time. So when it comes to investing, focus on finding the basics that work rather than getting lost in complicated details. 11th, shrinking your universe of opportunities. At Berkshire, we believe the best approach is having the freedom to invest wherever it makes sense. We're not limited by any specific rules or restrictions, except for the size of our fund. We don't box ourselves in by narrowing the scope of what we're willing to do. I've been fishing my whole life because my dad loves it. One thing I've noticed about him is that he never stays in one spot for too long if he's not catching anything. If a fishing hole isn't producing, he moves to a new spot. If he stubbornly stayed in one place all day, he wouldn't catch nearly as many fish. Investing is very similar. Opportunities in investing don't stay in one place for too long. You never know where they'll pop up next. So it's important to keep an open mind and avoid limiting yourself to just one industry or type of investment. A lot of funds make the mistake of focusing only on one area, like only investing in ESG companies, or companies that pay high dividends, or even just tech companies. But opportunities don't follow those rules. Sometimes the people who manage these funds know this, but it's easier to market and sell their products when they create a niche. I almost made that same mistake when I was starting this channel. I thought about calling it the gaming investor because I was tempted to focus only on the gaming industry. It seemed like a good idea at first, as I could build deep knowledge in that field, but in the end I realized that it would have been too narrow. There's a difference between sticking to your area of expertise and being too limited in your thinking. Opportunities can arise anywhere, even in places people don't expect. Ironically, these opportunities tend to move away from where people think they'll be and show up where no one is looking. That's because stock prices are set by people, and people often miss what's right in front of them. But we'll get into that soon. 12. Ignoring the power of compounding. One of the biggest advantages of long-term investing is the power of compounding. But many new investors overlook this powerful force. They're too focused on short-term gains or the next hot stock pick. Warren Buffett is famous for saying, "My wealth has come from a combination of living in America, some lucky genes, and compound interest." He's not kidding. The longer you leave your money invested and reinvest your gains, the bigger your returns can become. Compounding rewards patience and discipline, which is why Buffett suggests that the most important quality in an investor is temperament, not intellect. By consistently reinvesting your profits, even modest investments can grow substantially over time. The lesson here is simple. Don't let the desire for quick returns prevent you from capitalizing on the long-term benefits of compounding. Time in the market is far more important than trying to time the market. 13. Chasing hot tips and rumors. The allure of inside information or hot stock tips from social media influencers, friends, or experts can be tempting. But following rumors and tips without doing your own due diligence can be a dangerous game. Warren Buffett often talks about how successful investing requires both patience and careful research, not acting on the latest hype or hearsay. A hot tip might result in short-term success, but more often than not, it leads to poor outcomes. Investing based on rumors exposes you to unnecessary risks, as it lacks a solid foundation of research and analysis. Instead, focus on understanding the businesses you're investing in. Look for companies with a competitive edge, strong leadership, and a sustainable growth model. That's the kind of investing strategy that leads to long-term success. 14. Overconfidence in your knowledge. It's easy to fall into the trap of thinking you know everything once you've made a few successful investments. But the market is complex, and even the most seasoned investors make mistakes. Warren Buffett himself stresses the importance of continuous learning and surrounding yourself with people who challenge your ideas. Overconfidence in your knowledge can lead to reckless decision-making. For example, believing you can outsmart the market or that you don't need to do proper research because of past success can result in significant losses. Always remember that no one has all the answers, and the market can be unpredictable. Stay humble, continue learning, and be open to new perspectives to avoid the pitfall of overconfidence. 15th, omissions. The biggest mistakes we've made are the ones where we didn't take action when we knew we should have. It's not about doing something wrong, it's about doing nothing at all. For example, years ago, there was an opportunity to buy Fannie Mae when the company was struggling. We could have bought the whole thing for practically nothing, but instead I sat on the sidelines. Looking back, I probably cost Berkshire at least $5 billion by doing nothing. A lot of the mistakes people make are when they do something wrong, maybe making a bad decision or taking a bad action. But sometimes the worst mistake is the one you don't make, the opportunity you don't seize. Think about it. Not asking someone out on a date when you were interested, or not taking a risk in your career when you had the chance. In Buffett's case, it was not investing in something that was clearly a good move. It gets even worse when you combine this mistake with another one we've talked about before. Getting stuck on the price you paid for something. Buffett made this mistake with Walmart back in the 90s. He saw the company as a great opportunity at a certain price, but then the stock price started rising, and he hesitated. He was too attached to the initial price he was willing to pay, hoping the stock would drop again. It never did. This mistake ended up costing Berkshire around $8 billion in lost profits. He nearly made the same mistake with one of his best investments, See's Candy. Luckily, Charlie Munger was there to talk him out of it. Looking back, it's easy to say what we should have done, but when you recognize an opportunity that fits within your area of expertise, don't just hesitate or nibble at it. Go all in and take the full bite. So what do you think? Do you have any of your own investing mistakes you've learned from? Share your thoughts in the comments below. And if you're interested in hearing about some of Warren Buffett's best investments, check out the video linked here. See you next time.